Welcome to our latest explainer. Okay, today we're unpacking something massive. It's a structural shift that is actively destroying a beloved asset class right before our eyes. So if you, or maybe your fund, are holding industrial real estate or legacy shipping stocks, yeah, you're going to want to pay close attention. We're talking about a paradigm shift that completely challenges long-held assumptions and is just actively rewriting the rules of industrial real estate from the ground up. If you've been tracking the markets, you've definitely felt the shockwaves. We're going to dive into exactly why this is happening, the hardcore data behind the disruption, and what it all means for the absolute future of the global supply chain.
Just listen to this brutal reality check. If you own industrial REITs or UPS stock, your moat was just filled with concrete. Wow. I mean, we all know the old story, right? Amazon killed the shopping mall. But the wild new reality is, they didn't stop there. They literally just came for the warehouse. See, for years, traditional carriers like UPS and industrial real estate investment trusts enjoyed what they genuinely thought was this massive, impenetrable, protective moat. But Amazon has decisively shifted from being their largest, most lucrative customer to becoming their most lethal, scaled competitor. No joke, they are systematically dismantling the traditional B-tier real estate and legacy carrier moats. And honestly, they're doing it with absolute mathematical precision.
So, here's our roadmap for today's explainer. We'll be exposing the invincible warehouse myth, pinpointing the May 4 inflection, breaking down the CAC disadvantage and the efficiency paradox, and finally, we'll analyze cap rate compression to define the new logistics equilibrium. Let's get right into it.
Starting off with Section 1, the invincible warehouse myth, a fundamentally flawed thesis.
Which brings us to Section 2, the May 4 inflection, and the decoupling of growth.
Okay, so for much of the last decade, retail and institutional investors alike have operated under this really simple but totally flawed thesis. The idea that the continuous expansion of e-commerce practically guaranteed an infinite need for more warehouse growth. You know, more online shopping means more boxes, and more boxes just means you need more roofs to store those boxes under. Sounds logical, right? But treating logistics real estate as this monolith that only goes up is a massive, massive mistake. To actually understand the depth of this asset class, we have to look at one very specific inflection point, May 4, 2026. Historically, logistics was essentially this global duopoly run by UPS and FedEx. But on May 4, Amazon completely commercialized their spare capacity. They launched Supply Chain by Amazon directly to third parties. Overnight, they permanently inverted their relationship with legacy carriers, moving from a reliant customer to a massive enterprise-grade rival. And man, on that day, the market had a violent realization. The reaction was immediate. UPS stock slid 10.5% in a blink, and FedEx followed with a 9% drop. Meanwhile, Amazon's same-day delivery exploded by 30% year over year. The market suddenly fully understood that Amazon's internal logistics efficiency had reached a level where it could severely underprice the incumbents.
Now, the math behind this whole disruption centers on what we call the density trap. Specifically, we're looking at the yield per parcel. So UPS absolutely requires high package density per route to make money, and they charge an average of $13.25 per parcel. FedEx, they're sitting at $15.86. But Amazon, get this, they are moving 6.7 billion parcels at an aggressive $5.75 yield, half the price. To really grasp this density trap, just imagine a sprawling city bus route that suddenly loses half its passengers, but, it still has to pay the exact same amount for gas, maintenance, and the driver. As Amazon handles its own massive volume and aggressively poaches that high-margin B2B shipping, it literally strips that essential passenger density right out of the legacy networks. And because of this, UPS's domestic operating margin was completely crushed, going from 7% down to just 4% in early 2026. These legacy carriers are trapped in a vicious cycle right now. They either raise rates and lose volume to Amazon, or they slash prices to compete and bleed out their margins entirely. Moving right into Section 3, the CAC disadvantage, where we look at the brutal unit economics. So you're probably wondering, how exactly can Amazon afford to charge so little without completely collapsing their own business? Well, it all comes down to customer acquisition cost, or CAC. For a traditional third-party logistics provider, actually acquiring a shipping account is incredibly capital-intensive. I mean, they need massive direct sales forces, huge marketing budgets, and on top of that, they suffer from high account churn, all while operating on razor-thin 4 to 8% margins. But Amazon operates in a completely different reality. They integrate logistics into this massive, incredibly dense ecosystem. Their customer acquisition cost is heavily subsidized by their advertising business, which pulled in a staggering $68.6 billion in 2025 alone, alongside massive profits from AWS. Just imagine trying to compete with a delivery company whose entire fleet of trucks is literally paid for by their side hustle in digital ads. Because Amazon uses this commercialized spare capacity that's subsidized by alternate revenue streams, they create this impenetrable pricing ceiling, and traditional carriers, burdened with their massive fixed overhead costs, absolutely cannot break through it.
All right, Section 4. The efficiency paradox. Decoupling square footage.
Now here is perhaps the most mind-bending part of this entire shift. Most retail investors out there still think, hey, more e-commerce means more warehouses. But the clinical paradox we are actively seeing is that Amazon is shipping over 8 billion items while actually lowering the total square footage they need to do so. They are completely decoupling growth from raw physical space. Let's break down the technical mechanics of how they pulled off this impossible feat. Back in 2023, Amazon completely overhauled its U.S. network through regionalization, basically partitioning the country into 8 self-sufficient zones. By leveraging AI for predictive inventory placement and utilizing Dijkstra's algorithms, which, simply put, is just a mathematical way to instantly find the absolute shortest, most efficient path between 2 points in a massive, complex web, they totally optimized their entire picking network. And this wasn't just some slight incremental improvement. This mathematical optimization successfully cut their middle-mile touchpoints by 12% and reduced delivery distances by 15%.
76%. That's a huge number. Because of those localized AI and algorithmic optimizations we just talked about, Amazon increased its in-region fulfillment rate to a whopping 76%. What does that actually mean? It means they rarely need to cross country lines to ship a box anymore. Think about it. If a retailer can fulfill twice as many orders from the exact same amount of space using robotics and smart placement, the need for sprawling secondary overflow warehouses just disappears. For real estate investors, this single metric is the absolute nail in the coffin. Massive e-commerce output no longer requires infinite, physical, B-tier expansion, period.
Which brings us to Section 5, cap rate compression, and the harsh real estate reality.
This is the exact spot where the operational efficiencies of a massive tech giant directly collide with the physical, concrete world of real estate. You know, the old protective moat for landlords was simply owning land close to a major city. That was it. But today, the moat is the embedded technology within the facility itself. A legacy B-tier warehouse, which is typically around 100,000 to 500,000 square feet, usually has clear heights of around 24 to 28 feet in standard concrete floors. But here's the catch. Those facilities are completely technically obsolete for modern automation. These modern Amazon hubs house massive multi-ton automated vehicles, and because of that, they require super flat floors. Even a single millimeter of variance in the concrete can completely derail a multi-million-dollar automated fleet. It's crazy. They also need 36 to 40-plus foot ceilings and massive heavy-duty power capacity. Because legacy B-tier warehouses lack these hyper-specific specs, we actually saw national industrial vacancy hit 10% in those mid-sized spaces by late 2025. Meanwhile, modern mega warehouses, they sit tightly at less than 3% vacancy.
And the financial fallout of this technological divide is a massive, gaping valuation gap. Consider capitalization rates, which, if you're not familiar, is the primary metric real estate investors use to gauge risk and return. Amazon-leased or Amazon-adjacent properties are maintaining a very stable premium. Their cap rates are sitting comfortably around 4.5 to 5.5%, totally backed by rock-solid tenant credit. But consider Class B's secondary markets. Those cap rates are expanding dangerously, pushing up to 7.5%. And remember, when cap rates expand, underlying property values actively drop. This dynamic acts as a really firm floor for high-quality tech-enabled assets, but it serves as a crushing ceiling that is actively destroying the project values of secondary, non-automated warehouses.
Because of this rapid shift, major industrial REITs are absolutely scrambling right now. That supposedly invincible last-mile moat they thought they had, it is literally evaporating before their eyes. Take Rexford Industrial, for example, a major, highly respected player in Southern California. In early 2026, their net effective rents actually decreased by 10%. That extreme, unyielding pricing power we saw during the pandemic era is just completely gone. So to survive, REITs are being forced into defensive capital recycling, which, by the way, is essentially just a polite Wall Street term for desperately selling off your weakest, obsolete assets just to stop the bleeding. Rexford disposed of over $127 million in properties in a single quarter, purely to protect their balance sheets. Even global giants like Prologis are watching their speculative Amazon lease share glide downward, simply because Amazon is prioritizing building its own heavily customized facilities.
And that leads us to our final section, Section 6, the new logistics equilibrium, defined by high throughput. We really need to completely redefine the last mile thesis. Historically, last mile meant securing a small building as physically close to the customer's doorstep as possible. But today, it is no longer about proximity to the customer at all. It is exclusively about high-throughput robotic efficiency. Instead of leasing hundreds of tiny, inefficient stations from REITs, Amazon is out there building their own centralized robotic fortresses. Just consider the sheer scale of this Gen 13 mega warehouse boom. We're talking Wilmington, Delaware, 3.8 million square feet. Suffolk, Virginia, 3.8 million square feet. Ontario, California, a staggering 4.06 million square feet. To put that Ontario facility into perspective for you, that is roughly the size of 70 American football fields sitting entirely under a single roof. It's mind-blowing. Amazon handles the bulk of the intense labor with robotics right in these colossal central hubs, and then their delivery service partners cover massive delivery radii all from a single hyper-efficient node. Those legacy 100,000 square foot warehouses are rapidly becoming the obsolete orphans of the logistics world. They're just too small for automation and far, far too expensive to operate.
So, I want to leave you with this provocative question. Is your logistics portfolio actually built on modern technology, or is it just sitting on a mountain of technical debt? Look, the logistics real estate sector is no longer a monolith. It is violently bifurcated into a high-stakes technology business on one side and a legacy real estate business on the other. And the brutal truth we've explored today is that the legacy side is dying. The next time you evaluate a REIT or a traditional shipping carrier, look past the basic square footage and ask yourself if they actually have a sustainable moat or if it was just filled with concrete. Thanks so much for joining me on this explainer. Keep learning, and I'll catch you in the next one.